Hi and welcome to the Trading Bell Show. Glad that you have joined us and Merry Christmas, and of course looking forward to the new year. And I wish you very well right here from the Trading Bell Show. It's a season of the bells, as we have said, and this is the Trading Bell. So welcome. I'm joined by two amazing persons, and this is Ronnie Choka, Senior Research Analyst at Capital A, and Stella Soke, Senior Associate at Standard Investment Bank. And we want to just really look through how was 2024 as we really gear up for 2025. So welcome, and gentlemen and lady, welcome to the show.
Thank you.
Thank you.
Glad to have you here. Stella, I want to start with you, and I want to really open the conversation on speaking about the macros and really some of the influences that we have seen in a big way, especially to the economy and just the markets in general. What has been your keen observations on this?
Well, 2024 has been a great year in many ways. We've had so many activities from the start of the year, but economic-wise, the economy grew at a slower, or is estimated to grow at a slower rate as compared to 2023. And the main reasons include, but not limited to, lower disposable income, lower demand, as well as the economic disruptions that came with Finance Bill 2024, which saw significant uproar from the citizens of Kenya. So this has significantly slowed down the economic performance and economic growth.
Okay, interesting observations. One would think when you look at the inflation rates and the likes, probably there will be more disposable income because we had conversations how the food industry has been. But Ronnie, I want to bring you in as well. Did you make any keen observations on what influenced our economic growth? Any keen observations on that?
Thank you, Maina. I think 2024 can be characterized as a year of unprecedented volatility. Looking at Kenya coming in the context of the legacy effects of the pandemic, to geopolitical tensions in Russia and Ukraine. That of course disrupted supply chains, causing inflation to trickling into our economy. In response, we had central banks all over the world, including our own central bank, tighten interest rates rapidly to anchor these inflation expectations. However, I can give a lot of credit to the stewardship of the Central Bank of Kenya in collaboration with the National Treasury, insofar as they were able to mull the fiscal tools at their disposal to cool down inflation by the end of this year. I expected that maybe inflation will cool down to sub 5% around early next year, but it seems they were able to achieve that by December this year. So kudos to them.
Okay. Stella, kudos to the inflation, but Kenyans on the ground are saying we're not feeling it.
Mainly because a slower inflation does not necessarily mean that prices of goods and services has declined. It just means that the prices of goods and services are increasing at a slower rate. So when you look at the key or segmented items in the inflation basket, you get to see that some of these indices have grown by more than 50% in the last, say, 2-3 years. So when you look at the food index, you get to see that we have over 50% growth. You look at the things like electricity, both commercial and domestic use, over 60% growth. So when you look at that and then you get to see things like higher statutory deductions, which came with a housing levy. We have NHF now shift. We have higher taxes in terms of, for example, VAT on fuel, which came in with the Finance Act 2023. So all of these point to reduced disposable income for the Kenyan citizens, which means that they will not be able to achieve or to afford most of the things that have increased in price over time. So basically that's why Kenyans are not feeling the effects of a lower inflation. But then the translation is that a lower inflation is a decline. But the major translation from that is that prices are growing, but at a slower rate, which is a good thing, because at the end of the day, you do not expect to have stagnant prices over time. So what we look to achieve and what we always want to see is stability in the prices, and stability is translated from slower increases in prices of goods and services.
Okay.
Yeah.
So there's a hope. Probably 2025.
Yeah.
Definitely.
All right. So, Ronnie, I know you have mentioned about what the central bank is doing, and we really want to appreciate the MPCs and really what they have done. But the same reciprocation as expected for the banks is not happening, and Kenyans are concerned because the interest rates especially on loans, are still high. Why are we not seeing the effect coming down ASAP? Is it because the banks are still concerned whether MPC is going to again probably come with another change?
Yeah. I was listening to the central bank governor Kamau Thuge speak to during the most recent MPC meeting, and even in the press statement he stated he urges all banks to lower interest rates. And I wonder, because it really shouldn't come as a surprise that banks have not really responded in the same proportion as envisioned by the CBK, given that the central bank itself gave approvals to banks to roll out risk-based credit pricing, which in essence is a method of exercising differentiated risk pricing. Based on your risk profile, you're given your interest rate is priced based on your credit history and so on and so on. Absolutely. However, as you can imagine, it introduces some elements of subjectivity in terms of the ratings that are assigned to borrowers. And as such, it shouldn't really come as a surprise that banks have not lowered interest rates as fast. There's one bank I saw, they only lowered their benchmark rate by around 25 basis points when the central bank had lowered by more than a percentage point.
Wow.
So I think we opened, maybe the Central Bank of Kenya opened a Pandora's box in a sense, now that interest rates are not necessarily capped as they were pre-2017. We are in a new regime of, differentiated risk pricing. I can be charged, say, 18% on credit. You can be charged 17.5%. Different rates per borrower apply in this regime.
I don't know. Stella, when you hear that, I'm wondering what's the thought process behind the banks, because I would expect that they would immediately run to this, because this would encourage more borrowers to come in and have more liquidity out, which is a boost to the economy. But we don't see them doing that, yet they are key enablers of this. And I want you to comment on that as you tie it in with our public debt, because I want to know our status and how we do it. Please go ahead.
Yeah, so banks are in business, right?
They're in business,
So they're
You forgot that.
Exactly. So they're looking to make money.
Okay.
And lower rates won't make them money. And remember that we are coming from a very high interest rate environment in terms of government securities, which significantly crowded out the private sector. So as at now, banks and investors are rushing to lock in higher rates in the fixed income market before rates get to the single digits that the government has told us previously that they want to achieve. So
I want to dive in now and really change the conversation to just looking through our equities and the markets and everything else. And I just want you to just give an overview first on how we've been performing, especially as an exchange, especially in comparison to our peers. I know earlier on in the year we had really key milestones achieved. The exchange here being counted as the best as well globally and all that. And I just want to know, where are we and how are we faring?
Okay, I think the Kenyan stock market has grown by leaps and bounds, oscillating from the relative worst stock market in the world, close of last year, to the best exchange, not only by the first quarter of this year, but up to now on a year-to-date basis. Kenya's Nairobi Securities Exchange is the best performing exchange in USD terms, USD equivalents. Yes.
Wow. Yeah. Wow. Very good news there. Ronnie, Stella, let me bring you in, and I want you to just give some color on investor confidence in the country. How are we seeing, especially when it comes to the returns, and are we seeing the flocking now that we have been touted as the best exchange so far?
Investor confidence really improved immediately after the Eurobond buyback.
Okay.
The jitters on Kenya defaulting had taken a toll on Kenya, especially in terms of portfolio inflows.
Yeah.
There was significant capital flight from the NSE, but when the Eurobond was bought back, or we refinanced the 2024 Eurobond, we saw significant improvement, not only with regard to the capital flows, but also with the currency. So you remember when there was that capital outflow, we had issues with investors having difficulties in exiting because of lower supply of dollars. But after the buyback, we had so much confidence, and then we had the IFB that was issued in February, which also saw a lot of capital inflows from the foreign investors. So we have had good confidence since then. Also having loans, for example, from the IMF, which really helped in boosting the forex reserves. So this significantly built the confidence of investors, both locally and foreign.
Ronnie, investors are happy. They are here. What are you observing in the markets? Are they, when you look at, we still tout on the fact that we have a lot of foreign dominated, participation. Are we still seeing the same? Is there an influx? Are they getting returns? What's the state?
Actually, there are interesting developments in the equities market this year. For one, we noticed turnovers are up, strong double digits. We're now doing 75 billion equities turnover in the first 11 months of this year. Looking at the participation mix, for the first time in 5 years, you're starting to see a rise in foreign participation after a 5-year consecutive decline. So as of November this year, we had a foreign participation rate of 56%, up from 49% last year. So looking also at market valuations, if you look at industry price to earnings ratios, they're generally coming up. The market PE is coming up, meaning that investors are pricing in high expectations of improved corporate performance next year. So as a result, they're willing to pay more for a shilling of earnings per share, because the higher earnings per share are associated now with higher dividend payouts and higher capital gains as a result. Looking also at the direction of flows, foreigners have now trimmed down on their net exit activity that we've been seeing over the past 5 years or so. So we're seeing a brake pedal being put on flows. So we are starting now to see some months recording net inflows, which is a very good sign. And I think it was very much in expectation now that interest rates are starting to come down in the fixed income market, both in developed and developing economies. So that has compelled investors to, divest back into equities, and that's what we're seeing at the moment.
Lovely. All right, Stella, as we come to a conclusion of this, I want you to bring us closer to some of the environment, the operating environment we've had. And this year definitely has gone notably on a lot of taxation and policy changes that we have seen. And I don't know from the ground, because you're communicating with the people a lot, from the finance acts that we had to really introduce, and the impact of what we've seen with the new tax measures. What are you observing in general?
I'll comment on the private sector business environment.
Excellent, yes.
Which is heavy on input costs and largely depends on how this turns out. So there has been an increase in input costs back from 2023 when we had the Finance Act 2023, which also had an increase in many key things.
Sectors,
And I mentioned earlier about the VAT on fuel. So remember, most sectors, for example, in the manufacturing sector or even the economy at large, depend on fuel as an input. So when you look at that, and then you look at electricity, so electricity prices also have a fuel charge on them. So when we have an increase in fuel prices because of the taxes, then it will also translate to higher electricity prices. So we've had a very difficult issue with input costs in the private sector, which has then made output prices higher. So this means that again, we will have less demand from the buyers or consumers of these particular services and goods, which means that there will be constrained margins, which has again been a highlight of the year, with lower margins for businesses, which has also curtailed expansion and investment into new areas or new products.
I was looking at the markets. Normally we end the show with markets, but we just discuss it here. Through the year to date, top gainers we had East Africa Portland, Orchards, Kenya Power, I&M Holdings, and KCB, which we know definitely is quite significant, but I want you to just make a comment on them. Especially looking at some of them, we had highs of 297%. And 79% to 297% within those five, which is quite significant. Yes. Any comment on any of the sectors that you've seen there?
Yeah, for sure. As I spoke on earlier, some counters have recorded triple-digit returns this year, led by East African Portland Cement, which, as you know, was in the context of the industry, which is the construction sector, we had a buyout taking place on one of its rivals, which is Bamburi. And when you look at the book value of East African Portland Cement, relative to the market valuation, it was trading as low as less than 10% of the book value at some point. So the appreciation in its price could be interpreted as a correction. Or gravitation back to the industry average price to book valuation. So yes, that was a significantly undervalued stock. Fortunately, this year we've seen a turnaround to profitability on the counter, which again has further solidified its new valuation, as it were.
You know, one of the interesting observations is coming from what Stella has just mentioned, that we are seeing reductions on imports. And it's because of the people in their pockets really being strained. And then we come here, we are looking at the construction industry and we're looking at the stock here, it's doing super well. It looks like it's a mixed bag here. So it's really not easy to just point out some of these factors. But comment on the losers as well. I see the media industry has been touched a lot from Nation Media. I also see Kenya Re, I can see Standard Group, Sasini Sanlam. I don't really have a comment on it because you're also on the reds there through the year.
By and large, with Nation Media Group, they've just concluded their buyback, which we were yet to get the official results. However, in the context of other competitive performing stocks, the opportunity cost of holding your money in Nation Media was way higher compared to, even T-bills would give you better returns compared to what Nation, because they've not been paying dividends. And right now there's low investor tolerance for counters that are loss making or not paying dividends at all.
You'd rather go to
you'd even rather just do fixed income. But right now, all things considered, I think the stock market is well poised for a decent recovery next year.
Stella, the fixed incomes, the bonds, what are we observing? Because I know rates are going down. We are not happy, but go ahead.
Rates are going down and swiftly, to say the least. So I think we are looking at single digits, especially for the treasury bills by the end of the year. So
and we recorded very high, to as high as 17 there.
At some point. So investors who locked in the rates are the lucky ones. But going forward, the rates will go back to where fixed income investment asset classes are slightly supposed to be, so to say.
Yeah.
So the outlook in terms of fixed income, I feel like investors will go on divesting to the equity side, because equities will have better returns compared to the single digits in the fixed income environment.
Which is good news for Ronnie.
Yes.
And the market, right? Absolutely. I want to close by asking you guys to give you a parting shot. And the parting shot will be just outlook as well, 2025. What are you expecting? What are your random thoughts? I don't know who's going to start. Stella, you ready?
Yeah, no,
Go ahead. Yes.
Yeah, so in terms of the outlook in 2025, I'll look at it from two sides, the fiscal space and the monetary space.
Yeah.
So on the fiscal space, we are looking at the expenditure, revenues, credit score, and public debt.
Yeah.
So all that concerns that. So we are looking at, my expectation is that the government, for example, will not meet their revenue targets in the current fiscal year, which ends in June 2024, because of the business environment, again, that I've been talking about.
2025 now.
Yeah,
Yes.
yes.
Yeah.
So, So, and then we are looking at even higher revenue collections in the next fiscal year, again, which starts in June 2025.
Yeah.
So the finance bill in 2025, again, is expected to be a bit aggressive, so to say.
Okay.
But I believe that the approach will be different this time round, because we've had we've had the National Treasury say that there will be more communication, more transparency, and more public participation engagements. So I expect that from that end. In the monetary space, I expect rates to continue going down, the central bank rate, maybe to close at 8%. I'm optimistic with 2025, 8 or 7%. So this means that credit will be more affordable compared to where we are right now. And there will be less crowding out, because as we've seen, the government securities rates are going down. So I expect capital to be more, money will be released into the private sector. And with this, we will see more expansion and more thriving and lively business environment.
Thanks for that, Ronnie. You have a parting shot. 2025, yes.
My outlook on 2025 is rather bright. Yeah, I think we are out of the storms after a 5-year stagnation period. Inflation has moderated, meaning prices are stable. This is good for both businesses and consumers. For businesses, it means predictable costs, good for planning. For consumers, it means once prices are predictable, they're able to plan and consume on based on predictable price patterns. This should reasonably support positive earnings outlook for most of our listed entities. So by and large, I expect improved corporate performance next year across majority of the sectors that are not exposed to external risks. Secondly, looking at the equities market flows, I expect an influx of dollars next year. Now that fixed income returns are coming down in developed markets, foreign investors are encouraged to diversify back into emerging and frontiers, such as where we sit. So that should really propel valuations on our counters next year.
Wow. My goodness, thank you so much, Ronnie. Thank you so much, Stella, for your sentiments. And of course, to our viewers, thank you so much for really watching, and I hope you have a better view of how the year was, and of course, from the sentiments of the outlook 2025. And we really hope, from the words of Ronnie and Stella, it's going to be a great year. Thank you so much for your time. Merry Christmas and happy 2025. Of course, keep it locked here on the Trading Bell. We have great and much more.